I'm going to use this talk to introduce you to the investment management technique known as rebalancing. This discipline removes the emotion from the investment process that can lead you astray. Rebalancing forces you to, quote, buy low and sell high, and thus maximizes your investment returns. Essentially, rebalancing is the discipline of setting a target allocation for each investment in your portfolio, say 60% stocks and 40% bonds, and periodically rebalancing back to that allocation as market moves cause your portfolio to diverge from that target allocation. As you'll see, this discipline forces you to reduce your exposure to investments that have done well and increase your exposure to investments that have done less well. In other words, to buy low and sell high. To illustrate this technique, please follow along the following example. If you had to choose from among these three investment opportunities, which would you select? Investment A, B, or C? A, right? After all, it has the highest average annual rate of return of 12.5%. Are you sure you want to do that? I think not. Let me explain. Although investments A and B each have a higher average annual rate of return than the more plodding investment C, when you take a look at the actual dollars you're left with in each of the three options, you might be surprised by the result. To demonstrate what I am talking about, let's take a look at the results for an imaginary $100 investment. In year one, investment A goes up from $100 to $145, and then in year two it goes back down to $116 for a 2-year compound rate of return of 16%. In year one, investment B goes down from $100 to $88, but then springs back up in year two to $119 for a 2-year compound rate of return of 19%. Meanwhile, slow and steady investment C goes up each year by a comparatively modest 10%. At the end of year two, the compound rate of return is, by definition, still just 10%, but the value of the investment is now $121, thus outperforming in terms of cash both investments A and B. Perhaps most surprisingly, the optimal choice is to hold all three assets in your portfolio, resulting in a 2-year compound rate of return of 23% and the highest cash return result of $123. You might be inclined to say, okay, I know about the benefits of diversification, but this outcome really isn't about that. And this outcome doesn't occur by itself in a vacuum. It requires some effort on your part in the investment management discipline I mentioned earlier, periodic rebalancing. Continuing with the same example, let's see how this works. Going to our three investment options, A, B, and C, let's assume we invested our $100 evenly across all three. 33 in investment A, 33 in investment B, and 33 in investment C. This is called our target investment allocation of 1/3, 1/3, 1/3. Having done that, at the end of year one, investment A has gone up to 49, investment B has gone down to 29, and investment C has gone up to 36, for a total of $114 in your account. This is where and when the rebalancing work happens. If we now take that $114 and rebalance it back to our target allocation of 1/3, 1/3, 1/3, we end up with $38 spread across each of the three investments. This technique forces us to do something that is somewhat counter to most people's inclination, that being to actually reduce our commitment to some of our outperforming investments and increase our commitment to our underperforming investments. Though one might intuitively and emotionally be a little reluctant to sell off some of your winners and buy more of your losers, it forces the discipline of selling high and buying low. Now let's see what the effect of this is at the end of year two. Investment A has dropped from 38 back to 30, investment B has rebounded from 38 to 51, and investment C has done what it does and continues its steady climb to 42. Instead of the best outcome of $121 in your account, the rebalancing approach results in the best possible outcome of $123. The key lesson to be learned from this talk is that with a little discipline, you can remove the emotion from investing that mostly causes us to do exactly the wrong thing at the wrong time and learn how to manage your investment portfolio no matter what its size in order to maximize your results. A little discipline can work wonders.